Hello Gapper, Scott here, and this is the Gap Wrap for Wednesday, February 3rd. This morning we had smallish to mid-sized gaps. They were smallish in the futures, and I did trade the gap. They were a little bit bigger in the ETFs, which I'll show you in a moment. But let me show you the probabilities. We gapped down in the UCO zone. I think there was an ADP report or something that came out this morning on the job situation that was concerning to some people. I'm not exactly sure why. I don't really follow the news that closely because it's all built into the numbers, if you want to think of it that way. That's the way I think about it. So we were opening between yesterday's close and the open in the UCO zone. In fact, we opened precisely at 1094, so about a 3 1/4 point gap down in the ES. Based upon current market conditions, pretty good win rate. Profit factor just a hair weak for my likes. So not real motivating, but certainly not a deterrent either on its own. Looking at closing patterns, 73% historical win rate, profit factor 1.45, comparable profit factor going for extended target. Pretty good ratios. Those are good numbers there. And seasonality was all supportive of buying a down gap, and that's basically because the beginning of a month tends to be more bullish. So 2 out of 3 there. Quick look at the YM, very similar. 2 out of 3, very good numbers. Not as good on market conditions. NASDAQ, not quite as good, just a hair weak. Someone asked me about that this morning, and I just told them that even though I primarily trade the ES futures, you can trade the NASDAQ or the Russell or any of the markets if you've got the YM and ES lining up. In fact, I know some folks that trade individual stocks based upon seeing consistency between the YM and the ES. The ES is the granddaddy, but the Dow is also important, and it's also a check and balance on the data because this goes back about 7 years, this goes back like 11 years. So you can, 2 different time frames, if you will. You always want to see consistency in those time frames, with this being the more recent data, if that makes sense. So, in fact, before I go to my pre-market comments, let me show you something that I comment on pre-market. Look at, let me go here. See the last 3 bars of the futures yesterday? They sold off, so the 1600 price was around here. See that gold bar right there? And then we went, that's the 1605 bar, 1610, 1615. That's military time. That's because the futures pit session is open for 15 minutes after the cash session. But if you switch over and look at the spider, which mimics the cash session, it uses a 1600 settlement, so it does not show a price that sold off. Okay, so the fact it didn't sell off into the close made this gap bigger. See that big gap there? Okay, so I comment on that in my pre-market comments, which let me show you those real quickly, then we'll come back to these charts. So around 9:20 this morning, here's what I posted. I was actually a couple minutes behind, about 9:22. I posted right there for members the following. So market conditions were mostly neutral, as I just pointed out. There was some opening risk, possible pivot straddles, 600 period moving average. As it turned out, markets rallied just above these areas, so they did not come into play. And my nickname for the zone is the heat, even though for the past year I ought to give myself a different nickname for this zone because it has not taken much heat. The market's been so bullish, it's rallied very quickly. But generally, it takes a little bit of heat and needs a bigger stop. Supporting patterns, like I talked about ad nauseum in last night's video, opening above the high of 2 days prior is a positive for the UCO zone, and the probabilities were good, as I talked about. So here was my plan. I was fading these gaps. You see I didn't make any mention of position size. When I don't mention position size, I'm trading it at least 3/4 size, if not full, generally full. So I traded this full size today, and let's see, 2/3 of my target was at the gap fill area. Almost went half and half. Of course, hindsight's 20/20, but wasn't a perfect setup. So I went 2/3 gap fill, 1/3 extended target, which was just in front of the 1100 area. And let's see. Oh, I made a note to the ETF traders because of that sell-off yesterday in the futures. It made that ETF gap bigger, and I suggested they consider trading more conservatively. Not giving advice, but if I were trading it, that's what I was thinking. And I wish I'd been a little bit more clear, because what I was thinking was, when I used the word conservatively, targeting the majority of your position at gap fill. Now, I know that may sound like hindsight, But trust me, that's exactly what I was trying to intimate, because it was a bigger gap. And I'm going to show it to you a little bit more clearly in the relationship between the ETFs and the futures right now. So here are the 5-minute charts. You see the confluence was stacked heavily below the open. We opened right at the top of this area. That's always a good thing for a trade. We rallied very quickly, filled the gap, and then went on up and hit my extended target. My extended target was placed at 1099.50. Whoops, 1099. Yeah, 1099.50. And let's see when it was hit. Missed it right there by one tick. Pulled back, missed it there, and then caught it there. I think that was the high of the day. Yeah, so no, I thought I went higher. I could have sworn we went higher than 1099.50 today. That is where my target was, but wow, I didn't realize it. I got plain lucky there. I actually caught the exact high of the day. Swear I thought it went up another 3/4 points. Anyhow, doesn't matter. If I didn't catch the exact high, it looks like I caught the exact high for the day. That's just pure dumb luck. Just the way it worked out. But the extended targets are remarkably reliable in terms of a key area that you'll often see prices run to before they start faltering. Now, when we got up here, we got here so quickly. I told the folks in the trading room I was going to hold on to about 10% of my position for a possible continued run. We had news coming out, and I thought there was a chance we were going to have a trending day develop to the upside if we could break. I was wrong, and I told them my one concern was a pretty major one, was that internals were really weak up here. We had AD ratio was slightly climbing, ticks were two-sided, and AD ratio, advanced decline ratio, was not very strong. And sure enough, I was wrong. Some members of the room tightened their stop to right here around gap fill, and they were stopped there. I tend to give these trades a lot of room if I'm going to hold for any continuation. You got to risk money to make money, being the concept. And I tightened my stop to the entry area, and I got stopped in the last 10% there. So that was disappointing, but it happens. And this area did end up holding for the day, but it took a little bit more heat. Now let me show you one thing really important. So here is the high candle of the day, okay? I've got global tracking on, so you can see where the high was in the other. See how the white line moves in the other markets, okay? It coincided with the high, at least in the YM and in the Russell, but not the NASDAQ. Okay, it's right there. That bar right there. Now watch this when I go over to the ETFs. That is the high in the ETFs as well, and it coincides with gap fill. So that's what I meant when I set up when I was looking at my extended target. I was eyeballing where the 1600 bar was on the futures, which was right. Remember I pointed this out? Right up here. It was actually 10.99 1/4. If you look at the close right there, close is 10.99 1/4, and I went for 10.99.50, and that ended up holding it. So it's a great way. It's something very important for ETF traders and futures traders to pay attention where cash is filling its gap, because it's often going to be met with resistance. That's exactly what happened. So cash close held, and that was the peak of the futures. They just managed to rally a little higher. So that's a nugget for future consideration. And looking at the charts for tomorrow, what I see here, inside day, a lower high and a higher low in the YM and ES. That generally is a risk factor for gaps down. What else stands out? Near doji, if you look at the ETFs, we've got ETF dailies, dojis. That's a risk factor for gaps in either direction. Looks like the Qs have a little bit of relative strength. So a gap down may be a little safer in the Qs or the NASDAQ futures, but a gap down would certainly be a little bit concerning and riskier than normal. And we got 3 higher lows. Higher low, higher low, higher low. Got it? So that's 2 risk factors just off the top of my head, not even considering what my database will find tonight. But gap down is definitely going to be riskier tomorrow. Gap up, probably be okay. A little bit concerning since it'd be near this last week's high. So I may trade cautiously, if at all, tomorrow. And that is the Gap Wrap for Wednesday, February 3rd.